And the Russians, they know what's going on because they say London controls the market now, even though the UK doesn't produce any gold. The reason they can control it is because sovereign countries are daft, or I don't want to say, or stupid enough to leave all their gold with the Bank of England. And we produce the most gold. We're going to have our own market. And I think that's going to chip away even more at the paper games on LBMA and COMEX, because COMEX and LBMA are kind of linked. They're attached at the hip, I would say, and their objectives is not really to have a physical market that functions for physical delivery.
Russian officials argue that London's dominance in bullion storage and pricing exerts artificial influence over global gold markets. They point out that many sovereign reserves are still stored in the UK, effectively granting unchallenged control to Western institutions. With this dynamic, Russia projects that the system favors paper trading over physical delivery, thereby undermining true price discovery. Moscow has publicly announced its intention to establish a gold exchange, for example, Moscow World Standard, a move perceived as designed to bypass London's LBMA dominance and challenge market manipulation. At the same time, growing institutional demand for safe haven assets amid geopolitical uncertainty is fueling robust market inflows into gold storage in London, reaching multi-year highs, even as Russia seeks alternative frameworks. Mario Innecco, a former futures trader with 2 decades of experience, notes growing concerns in the silver market. Physical silver supplies in COMEX-approved warehouses are at record lows, around 155 million ounces. He highlights that COMEX doesn't own these warehouses directly. Banks like JP Morgan operate them. At the same time, the gold futures open interest is dropping, signaling a decline in public participation. Additionally, there's a squeeze on SLV, a silver ETF shares. They can't be easily borrowed anymore, and lease rates have surged. This suggests bullion banks are struggling to suppress silver prices by selling borrowed shares without having to buy physical silver. He believes this physical tightness is intensifying and will likely continue driving prices higher. In the 1970s, the Hunt brothers turned to silver as a hedge against inflation after the U.S. abandoned the gold standard, triggering regulatory backlash. Today, a similar surge in physical silver buying by wealthy individuals could trigger significant price movements. If you find Mario Innecco's insights compelling, make sure to like this video, subscribe to the channel, and ring the notification bell so you don't miss future updates.
I mean, I worked in the futures market for 20 years, mostly trading government bond futures and interest rates. And I did follow gold futures and silver futures quite closely once I started buying gold in '02. But I mean, I don't follow the data very closely. A lot of people do, and sometimes I look at what people say. But one thing that seems to be happening that I think is quite important is that the supply of physical silver in the COMEX warehouses is dwindling, and it's at record lows. I think 155 million ounces. And what you need to understand is that the COMEX itself doesn't have like a warehouse. They just have, say, oh, this warehouse owned by JP Morgan, or that is qualifies as a COMEX warehouse. So I think that's an important aspect of things. And I've noticed as well, I don't know how it's developing right now, but that open interest in gold futures is dropping a lot. Open interest means that the higher the open interest, the more the public is involved in the market. So it looks like people are not getting as involved. So yeah, and I've seen recently as well that the SLV, which is the ETFs for silver, I think it was last week and today as well, you can't borrow shares from the SLV. And why would you want to do that? Well, I think the bullion banks, they did that with PSLV a few months ago, if you remember. If you remember it, they were borrowing the shares to sell the SLV to keep the net holdings of SLV like neutral, because there are a lot of people buying PSLV, excuse me, and the trust had to buy physical. So if the swap dealers or bullion banks were able to borrow PSLV and sell it, it neutralized that increase, so they didn't have to buy physical. So they're trying now, I think, with the SLV, but the problem is they can't borrow. The lease rates for SLV shares has gone through the roof. And I think that squeeze in silver is going to continue. And today, as we speak, gold is tested 3,400 again in the spot, and we're close to 39 again as well in spot silver. Back in the 70s and 80s, the Hunt brothers were the main guys who went into physical silver. They started actually buying futures in the early 70s and taking delivery in the early 70s. And I suspect it's because when Nixon closed the gold window in 71, they knew what was coming in terms of inflation, but they couldn't buy gold, so they started with silver. But then they got over their heads a little bit, and the regulators and the Fed came after them. But when you have dozens of small, not small, of course, they're billionaires, but dozens of people with a lot of wealth, and maybe half of them start buying silver like that, it could make a huge difference. And I agree with Andy Schechtman. I've been telling people ever since I started following gold, when I bought my first Krugerrands in '02, I noticed that the markets behaved in a funny fashion, like they did the same thing at a certain time every day, which is unusual for markets. And then I discovered GATA, Gold Antitrust Action Committee, and Bill Murphy. And that's one of the things he said. Physical, you need physical. You need to take delivery on these exchanges like COMEX. Yeah, unless you're a big fish, they're not going to make it easy for you to take delivery. I think 2 or 3 years ago, Rafi Faber with a few other guys tried to take a delivery of one contract of silver, which is 5,000 ounce bar, and they made it so hard they had to give up. So yeah, it's definitely the kryptonite, taking delivery, and I think it was one of the reasons why they created because the bankers are ETFs and things like that. But in terms of manipulation, you're saying about the manipulation of gold and silver, some people might say, well, if they've been manipulating it, how come the price is going so much higher? And my retort, or my answer to that, is that they try to keep the public scared of going into gold and silver, because sometimes they come in and they smash the price, and they create a lot of volatility. And I don't know if you've seen this, Jesse. Back in the 70s, there was communication between the London bullion dealers and the U.S. Treasury, and also the State Department about the coming legalization of gold on January 1st, 1975. And one of the dealers in London said, yes, the creation of a futures market should help keep Americans away from hoarding physical gold, because it's going to create a lot of volatility, and the futures market is going to dwarf the physical market. So that's how they do it. But yeah, I think people are waking up to the fact that the only real way to own gold and silver is to buy the real thing. And I think the billionaire there, Mr. Bateman, is an example of that.
Mario reveals that silver has historically spiked to $50 during major financial crises, such as those in the late 1970s and 2011, reflecting deep systemic stress, like the near breakdown of the dollar and the European sovereign debt crisis. Silver, long seen as the money of the masses, often signals economic distress. Today, Japan faces rising long-term bond yields, JGBs, due to mounting debt, inflation, for example, rice prices doubling, and political shifts. Japanese institutions and investors have long been a reliable source of demand for U.S. treasuries. Still, a relentless surge in Japanese government bond yields is flashing a warning for U.S. bondholders, raising the risk that Japanese money could start flowing home just as global appetite for U.S. debt wobbles. There could be a trigger point where Japan's investors suddenly repatriate their capital from the U.S. and into Japan. Some traders sense that this point is coming, which is why USD-JPY is being offered as JGB yields rise, with the opposition pushing for increased spending and the Bank of Japan attempting to tighten its policy. This tension could trigger broader instability in global bond markets, including U.S. Treasuries. Hence, silver and Japan's financial situation are worth watching closely. Since being excluded from major Western markets, such as the London bullion market and COMEX, following the Ukraine conflict in 2022, Russia has redirected its gold trade primarily toward China. Sanctions and refinery restrictions forced this shift. This highlights the sector's resilience and the country's ability to navigate geopolitical financial isolation. Let's reflect on the interview.
Silver, I guess the reason why I said that is because the last time, two times, well, the only two times silver went to around $50, back in the late 70s, early 80s, we saw almost a breakdown of the dollar system. We saw the US Treasury issuing bonds in Deutschmark and Swiss francs. They were called the Carter bonds. So that was like I think a signal that things weren't well, and silver, having been the money of the masses for thousands of years, reflected that. And the same thing, I guess, in 2011, we saw the European sovereign debt crisis in the countries of the south of the EU, like Portugal, Italy, Ireland, Greece, and Spain. I know Ireland is not in the south, but it was kind of in the same fiscal situation. And silver that year, when that crisis started, 2011, went to 50. So that's why I mentioned silver. The JGB market, that's the Japanese government bond. I've been covering it for years on my channel, that eventually all the debt and liquidity created by the Bank of Japan, and all the debt that's been taken by the government there, is going to come home to roost. We've been told by the Keynesians and mainstream economists that Japan has always been in a danger of deflation. But in the last 12 months, I think rice prices went up 100%. So the public, they're starting to feel the pinch. They know that deflation is really not there. And by deflation, I mean falling prices. I know that deflation is the collapse of the money supply, but things get confused a little bit. But now in Japan, the long-term yields for JGBs are spiking massively, and they could spike even more starting this week, because we had an election this past weekend in Japan. The government lost its majority in the upper house, and that's quite serious because of the opposition. They want more fiscal stimulus. They want more tax cuts. The Ministry of Finance and the Bank of Japan, they're trying to rein in all this money printing and liquidity. So this is throwing a spanner in the works. It could spook investors, and JGB yields could rise even further. And that weakness and drop in JGB prices could spread to treasuries and other government bonds, like the gilts and the European government bonds. So that's why I think it's very important to keep an eye on silver and Japan, something to speculate on. But I think the Russians, they're more serious about having a real physical market. And yes, this is just going to continue to chip away at the West's, and especially London's, control of the price finding mechanism. And Shanghai, they're doing the same thing. Shanghai Gold Exchange, they're opening also depositories elsewhere. So yeah, I think the trend is for more and more real physical gold and silver. trading, and I think the Russians are very much aware of the paper game. And why do I say that? Well, because there was a, a, a summit, I think it was in the Yukon 2005, organized by GATA, and they had like a economic advisor to President Putin who went there, and he found out about all the bullion bank paper game in gold and silver, especially as it pertains to JP Morgan and the bullion banks. So I think the Russians are aware of this, and so are the Chinese, and they know that the Achilles heel of the Anglo-American empire is the fact that they've kept their currencies inflated. They've kept the perception that they have value by suppressing gold and silver. So yeah, it's interesting times. But as I said, it looks like now Besson and whoever's going to be nominated as the next Fed chairman, they want to join up with the Treasury and pump things up even more. I mean, we're supposed to be in a great economy in the US, but they still want to cut rates down to 1. It doesn't make sense. So that's how I see tariffs. They're just a distraction. They're not going to solve anything. I think the only way this problem is going to be solved is through a major collapse of everything, and then people will have to sober up, and not just Americans. Here in the UK as well, we run big trade and current account deficits. Maybe not as big as the US, but yeah, we'll have to sober up. We'll have to start working and producing and earning our keep in the world. And that's how I see it. As for the sanctions, they haven't really worked that well, have they? All the sanctions against Russia or other countries. All it's done is, and I saw that Trump said that there's a small group called BRICS. It's falling apart. I mean, he's in total denial, I think. And, BRICS now is 45% of the world's population. It's growing, 40% of GDP. And I'm not defending BRICS nor the West. I'm just looking at things and, seeing how they're going to evolve. Because if you believe in what politicians tell you, it's going to hurt you financially, I think.
Amid growing suspicion in Western-controlled gold and silver markets, Russia and China are carving out new paths in the precious metals trade, bypassing conventional hubs such as London and the COMEX. This move reflects growing concerns about paper market manipulation and the erosion of genuine price discovery. Simultaneously, Japan's financial instability, caused by inflation and bond market stress, may catalyze broader global market volatility, which has historically favored silver. With actual silver supply tightening and demand rising, geopolitical and economic variables appear to be poised for a potentially explosive surge in precious metals prices. Could Japan's shifting bond dynamics spark a global shift toward precious metals, such as silver? Will Russia's new gold exchange and increased trade with China eventually challenge the LBMA's pricing power? Please share your thoughts in the comments section below. We'd be delighted to hear them. Don't forget to subscribe for more videos and give this one a thumbs up if you found it helpful.